All right, let's talk about a professional strategy that can seriously level up your trading game, scaling. We're going to break down the art of scaling into and out of trades. This is all about a system that helps you maximize your winners and, maybe more importantly, keeps your emotions out of the driver's seat. So let's dive in. So let me ask you this, and be honest. Have you ever sold a winning trade, patted yourself on the back for being smart, only to just watch in pure agony as that thing continues to rocket higher without you? Ugh, it is one of the most frustrating feelings in all of trading, right? But what if I told you there's a methodical way to deal with that? See, at the very heart of that frustration is this constant tug of war. On one shoulder, you've got the voice saying, lock it in. A profit is a profit, don't let this turn into a loser. But on the other shoulder, you've got the voice screaming, let it run, this could be the one, the huge move. It's a battle that every single trader fights on every single winning trade. And the answer to that internal battle is scaling. Now, look, it's not some kind of magic bullet. It's a strategic framework. It's a set of rules that lets you do both. You can lock in some of those gains to protect yourself and leave a piece of the trade on to catch that potentially massive move. So let's get our terms straight. First up is scaling in. This is all about how you get into a trade. Instead of just jumping in with your full position size at one price, you build your position in smaller pieces. You can kind of test the waters. And then as the market starts proving you right, you can add more. And then you've got the flip side, scaling out. And this right here, this is how you exit a winner like a pro. You take your profits off the table in chunks at levels you decided on before you even got in. This is exactly how you solve that lock it in versus let it run problem. You get to do both. Okay, but before we get into the cool strategies and the playbook, we have to lay down the law. Scaling is an incredibly powerful tool, but if you do it without discipline, it can be really, really dangerous. So these 3 rules, they're completely non-negotiable. And rule number 1 is by far the most important. I'm going to say it again so it really sinks in. Never add to a losing position. This is not up for debate. Adding to a trade that's moving against you, well, that's called averaging down, and it is probably the fastest way to blow up your trading account, period. So let's look at how these rules work together. First, like we just said, no averaging down, ever. Second, you have to manage your total risk. Every single time you add a new piece to your position, that new piece needs its own stop loss, and the whole trade, all combined, has to stay within your risk limits. And third, and this is a big one, you have to trade, not cope. Scaling is a strategic weapon. It is not an emotional tool to revenge trade or chase your losses. Okay, with those rules firmly in place, now we can get to the fun part, the playbook. Let's look at some of the most common and, frankly, most effective techniques for getting both into and out of your trades. So here's a quick look from 30,000 feet. For scaling in, you've got things like pyramiding, that's adding to a winner, or a confirmation ad, where you wait for the market to give you the green light before adding size. And for scaling out, you have classics like the 50-50 method, selling in thirds or quarters, or using a trailing stop to protect that final piece of the trade. Let's zoom in on 2 of the most popular plays out there, because they're balanced and super effective. First is pyramiding. You're only adding more size when the trade is already working, when it's moving in your favor. You're literally riding the wave of momentum. Then for getting out, you've got the 50-50 method. You sell half at your first target, bank that profit, and take risk off the table. This is brilliant because it massively reduces the psychological stress of managing a winner. Okay, theory is one thing, but seeing it in action is where it really clicks. So let's make this real. We're going to walk through a simple, hypothetical trade that puts these 2 techniques together. We'll pyramid in, and we'll use the 50-50 method to get out. Here's the game plan, step by step. Step 1, you put on your initial trade, risking what we'll call 1R. That's your standard single unit of risk. Step 2, as soon as the trade is profitable by that same amount, you add a second, smaller piece. Step 3, once your total position is showing a nice profit, you sell half of the whole thing. And finally, step 4, the best part, you move your stop loss to your entry price on the remaining half and just let it run. Hitting that first profit target, that +1R mark, that is the trigger. That's the key decision point. It's the moment your plan kicks in and takes over. You're not guessing anymore. You're not getting emotional. You are simply executing the plan you made when you were calm and rational. This is what it's all about. And just look at the result of this. It's beautiful. By selling half and moving your stop to break even, you have now engineered what we call a risk-free trade. You've already put money in your pocket, you literally can't lose money on the trade anymore, and you still have a ticket to the show, ready to catch a monster trend if it takes off. You get the best of both worlds. So we've covered the what and the how. Now let's talk about the most important part, you. How do you take these ideas and start using them in your own trading in a disciplined, methodical way? Right here. Use this checklist before you ever even think about adding to a trade. It just forces you to stick to those golden rules. Is the trade already a winner? Does every piece have a stop? Is my total risk under control? But the most important question on this list is the last one. Was my exit plan decided before I ever clicked the buy button? That right there, that's the difference between an amateur and a pro. At the end of the day, scaling is a very personal tool. Some traders just do better going all in, all out. It fits their personality. But many others, and I include myself here, find that taking partial profits actually helps them stay in winning trades for much, much longer. But you won't know what works for your brain until you test it, track it, and look at the hard data in your trade journal. So that really only leaves one question, doesn't it? Which plan are you going to test first? Are you going to try the pyramid with a 50-50 exit? Or maybe just start with a simple plan of selling in thirds? The key is to just pick one, define your rules with absolute clarity, and start collecting your own data, because that is how you turn this knowledge into a real, tangible edge in the markets.